All right, let's dive into this. Value investing, huh? You've really been digging deep into this stuff. It looks like some great research here.
Oh, it's a fascinating area. Not just some quick tips and tricks, but a whole way of thinking about the market. And what's really cool is your sources actually highlight three different approaches within value investing.
That's what caught my eye too. It's not just one thing, right? There's like these different flavors of value investing.
Yeah, and they all kind of challenge that efficient market thing, but in different ways.
Like that the market always gets it right, prices things perfectly.
Exactly. That's the idea they're pushing back against.
All right, so let's start maybe just by like defining it. When we say value investing, what are we even talking about?
Well, the simplest way to think about it is finding assets, anything really, that's trading for less than it's actually worth.
Oh, that sounds like a pretty good deal. I mean, who wouldn't want that?
That's the idea, right?
Yeah.
But it's not just about, like, quick flips.
No, more like finding those hidden gems,
Yeah.
right?
Yeah. The overlooked stuff, the things that are maybe out of favor, they focus on what a company has right now. It's assets in place, they call it, not just. Like hopes and dreams for the future.
So not getting swept up in the hype, right?
Exactly. Solid companies, proven track record. That's what they're after.
Okay, so you've got these three main strands, right? Passive screening, contrarian investing, and activist value investing. What's the difference?
So each one kind of uses different tools and ideas. Passive screening, that's about having very specific criteria, almost like a checklist, to find those undervalued companies.
You have a filter, narrowing things down. And your research mentioned Ben Graham's 10 screening criteria. He's like the godfather of value investing, right?
Oh, absolutely, a legend. He even had this whole formula to figure out a stock's worth. Like, no guesswork, just boom, the number.
Wow, taking all the emotion out of it. So did his stuff actually work?
Well, yeah. There was this study, they looked at his criteria, and if you used them between 1974 and 1981, you could have beat the market.
That's pretty impressive. What else did he believe in?
Big on discipline, being patient.
Yeah.
And he always said there's a difference between being an investor and a speculator.
Like one's doing their homework and the other's just rolling the dice.
Exactly. He wanted people to really understand a company before buying its stock.
And there's that whole Mr. Market thing, right?
That was his idea. Mr. Market, he's this fickle guy, always offering you prices, but they might not reflect the true value.
Kind of like that used car salesman who always has a deal, but you never know if it's actually a good one.
Uh-huh. That's a good one. And Graham said, we can use Mr. Market's moods to our advantage.
Buy when he's down, sell when he's up, right?
Bingo. Ride those waves, but don't let them control you.
All right, so speaking of value investing legends, can't forget Warren Buffett. He learned from Graham, right?
Oh, yeah. He's like Graham's star pupil. And he's done pretty well for himself. Partnerships, Berkshire Hathaway, the whole thing.
I mean, he's like the icon, right? What are some of his key principles?
Well, he always talks about understanding the business you're investing in. Not just the numbers, but the actual company, what it does, its competition, the whole picture.
You got to know what they actually sell, right?
Absolutely.
Yeah.
Simple businesses, consistent track record. That's his thing. And he loves a good management team.
So it's not just about the product, it's about who's running the show.
Right. People who are honest, independent, actually passionate about the company. And he has this interesting idea about owner earnings.
Now, I remember that from your notes, but can you explain it again?
Most folks focus on that income, right?
Yeah.
But Buffett says, look, that doesn't tell the whole story. He looks at owner earnings, which is basically the cash flow the owners have after paying all the bills and reinvesting.
So it's like what's left over, right?
Exactly. The
Like-
real earning power of the company. And of course, he looks at the financials, but always within the bigger market context.
So it's not just the numbers in isolation.
No, he uses this thing called the risk-free rate to figure out the present value of future earnings. And he's a master at taking advantage of market ups and downs. Buys when everyone else is panicking.
Man, sounds like he's always thinking a few steps ahead. But here's something I found interesting. Buffett's a legend, but his performance lately.
Yeah, it's not been as spectacular as it used to be, especially since around 2000.
So is he losing his magic touch? Or is something else going on?
Well, some folks think the market's just different now, more information, more competition. Everyone's trying to do the same thing.
It's like value investing's gotten too popular.
Uh-huh, maybe. And Berkshire Hathaway, it's huge now. It's harder to be nimble to find those undervalued deals when you're managing that much money.
Makes sense. And I guess the world is just more unpredictable in general, right?
Right. All those big economic events, they can throw a wrench in even the best plans. So is it Buffett's approach that's not working, or is the whole game changing?
Now that's a question, and one we'll have to explore further as we dig into all the challenges of value investing.
It really makes you think. But let's get into some of the nitty-gritty. Your research talks about all sorts of metrics, ratios, things value investors use to check out potential investments.
Yeah, it's like a whole toolbox of numbers. Kind of intimidating, honestly. Where do we even start?
Well, a lot of folks start with the price-to-book ratio, PB ratio, they call it.
PB. Okay, so that's comparing the stock price to the book value, right?
Right. So you're basically looking at the market value compared to the company's net worth on the books.
Okay, and a low PB ratio, that could mean the company is undervalued.
Could be like finding $1 for 50 cents.
Oh, I like that. But your sources also mention some warnings about just chasing low PB ratios.
Oh, for sure. Book value, it's all based on past accounting stuff, might not reflect what those assets are really worth now. And sometimes a low PB, it's a sign the company's in trouble or just, not going anywhere.
So, gotta dig a little deeper, huh?
Exactly. Can't just go by the surface. Now, there's this other one, Tobin's Q. That's kind of interesting.
Yeah, that one seemed a bit more complicated.
It is a little more nuanced. It compared the market value to what it cost to replace all the company's assets, like rebuild it from scratch.
Oh, that's an interesting way to think about it. So, low Tobin's Q, does that mean the company's like a bargain?
It could mean it's undervalued,
Mm-hmm.
or maybe mismanaged, or even, ripe for a takeover. Someone might see all those assets and think they can do a better job.
So Tobin's Q can tell you some stuff, but it's not always easy to figure out.
You got it. Some of those assets, especially if they're unique to the company, really hard to put a price on replacing them, need more info than just what's in the standard reports.
It's like more detective work then. Okay, now this one's pretty familiar, the PE ratio, price to earnings.
Ah, the classic. So stock price compared to earnings per share, basic stuff.
Right, so how much you're paying for dollar of earnings, low PE, good deal, right?
Well, Ben Graham loved a low PE. And there's actually lots of research that says over the long term, low PE stocks do better.
That's pretty convincing, but I know there are also some warnings about this one too.
Oh, yeah. Got to be careful. Some companies, their earnings are really risky, unpredictable, might have a low TE just because nobody trusts those earnings to last.
Like that used car again, maybe it's cheap, but then the engine falls out.
Exactly. And you got to watch out for accounting tricks, too. Some companies, they get creative with their numbers, make earnings look better than they are, just to get that PE down.
Sneaky. So you really got to understand, the quality of the earnings, not just the number itself.
Absolutely. And don't forget taxes. Sometimes companies pay high dividends to attract investors, especially when their PE is low, but then you end up paying more in taxes.
Right. Got to factor that in. And I guess low PE could just mean people don't think the company's going to grow much, right?
Right. Could be a stagnant business. And value investors, they want companies that'll create value over time. Growth matters.
Okay, so it's not just one number, it's a whole bunch of stuff to think about.
And we haven't even touched on enterprise value to EBITDA or...
Whoa, slow down. What's that one?
That one, it kind of tries to fix some problems with just using the PE ratio. It looks at debt, too, and earnings before all the interest and taxes and stuff, EBITDA.
So a more complete picture, you're saying?
Yeah, more holistic. You're looking at the total value of the company, no matter how it's financed. Good for industries with lots of debt, like those big factories and stuff.
Okay, so that makes sense for certain companies, but still, got to be careful.
Always.
Yeah.
Need to see if the company's actually making good use of its investments, not just piling on debt for no reason.
It's like you can have a fancy car, but if you don't know how to drive it.
Exactly. Now, another one that's getting popular, especially when people are worried about accounting tricks, is the revenue multiple.
Revenue multiple. So that's like price to sales, right? How much you're paying for every dollar of sales.
You got it. Low price to sales could be a sign the company's undervalued.
Makes sense. But I guess companies with tons of debt could game that one too, right? Inflate their value.
Oh, absolutely. That's a tricky one. And you got to look at profit margins, too. Maybe they're selling a ton, but making pennies on the dollar.
Right, so profitability still matters, even if the revenue looks good. Okay, what about dividends? High dividend yield, that's gotta be good, right? Cash in your pocket.
Well, some value investors love them. It can be a sign of stability, companies doing well enough to share the profits.
But your research said it's not like a guaranteed thing, that dividends always mean good performance.
Yeah, the data's kind of mixed on that one. Sometimes high dividend stocks do great, sometimes they lag behind.
So not a foolproof strategy.
Nope. Got to look at the taxes, make sure the dividend's sustainable, and see if the company's still investing in growth. Sometimes paying out big dividends means they're not putting enough back into the business.
So trade-offs to consider. It really seems like the lesson here is use these numbers as clues, but don't just blindly trust any one of them.
Acexactly. Each company, each situation, it's unique. You got to do your homework, understand the whole picture. Now, all these metrics, they're based on accounting, right?
Right.
But those numbers, they can be, well, let's just say flexible.
Oh, yeah, I've heard stories. So how do value investors deal with that?
They get creative. They adjust those earnings, those book values, try to get a more accurate picture, like they'll use normalized earnings sometime.
Normalized. What's that?
So some businesses, their earnings go up and down a lot, like a roller coaster. Normalized earnings, that's taken an average over a longer period, so you smooth out those bumps.
Oh, like looking at the average temperature for the whole month, not just one crazy hot day.
Perfect analogy. And they'll adjust for one-time events, too. Like maybe the company had a big legal expense one year that shouldn't really count against their regular earnings. Or they'll try to estimate costs for things that'll happen in the future.
Sounds complicated.
It can be. But the point is, they're trying to get to the real underlying profitability. And then there's Buffett's thing, the owner earnings.
Right, focusing on the cash flow after all the essential spending.
Exactly. What's really available to the owners, like checking the company's pulse, not just its temperature.
I like that. Okay, and they tweak the book value too, right?
Oh, yeah. Book value, that's supposed to show you the company's assets. But sometimes it gets inflated by stuff that's hard to value, like goodwill from acquisitions or intangible things like patents.
So they focus more on the tangible stuff, the things you can actually touch.
Exactly. Land, buildings, equipment, that sort of thing. And sometimes they'll look at this thing called net working capital.
That one sounds familiar. It's like the company's short-term cash situation, right?
Bingo. Current assets minus current liabilities. If a company's trading for less than its net working capital, it could be a screaming bargain. Like finding hidden cash.
Okay, so all these numbers, they're important, but it's not just about crunching numbers, right? You talked about the moat, too, the company's competitive advantage.
The moat. So important. That's what makes a company special. Lets it keep making money in the long run.
Yeah.
Keeps the competition at bay.
Like a castle with alligators in the moat. Hard to attack.
Exactly. Buffett loves companies with wide moats. They're the ones that can really stand the test of time.
So what makes a good moat?
Oh, all sorts of things. A strong brand, big economies of scale, network effects. Sometimes it's about having special technology nobody else can copy, or even government regulations that protect them.
So lots of ways to build up your defenses.
And then there's a margin of safety, which is related to that. It's about buying a company for less than it's really worth. So even if you're a little wrong, you're still okay.
Built-in buffer, kind of like insurance.
Exactly. Nobody knows the future for sure, so that margin of safety can really save you. Now let's switch gears a bit. Contrarian value investing, that's a whole other animal.
Right, that's the one where you buy the stuff everyone else is selling, the unloved companies.
Bingo. Contrarian investors, they believe the market overreacts, gets scared, and pushes prices down too far.
So you're looking for the bargains, the things that have been unfairly punished?
Precisely. And there's actually research to back this up. Studies show that stocks that did badly in the past, they often do better in the future. It's called mean reversion.
So sometimes the best buys are the ones everyone else is running away from?
That's the idea. But of course, it's not a sure thing. Got to be careful.
What kind of things should people watch out for?
Well, transaction costs can eat into your profits, especially with those cheap stocks. You're buying and selling more often, so those fees add up.
Yeah, makes sense. It's like paying for gas every time you drive around looking for a parking spot could end up costing you more than the spot's worth.
Good one. And then there's tax loss selling. People dump their losers at the end of the year to save on taxes, so that can push prices down even further.
So you got to be careful not to bite into a falling knife.
Exactly. And maybe, most important of all, you need patience. Those beaten down stocks, they might take a while to turn around.
Not for the impatient folks.
Now, we've talked about buying undervalued stuff, but contrarian investing is also about selling things that are overvalued. It's all about playing the expectations game.
Expectations game. What's that mean?
So if the market overreacts to news, both good and bad, that means sometimes expectations get out of whack. They don't match reality.
So you're looking for those mismatches, those times when the story and the numbers don't add up.
Right. Maybe you buy a stock where expectations are too low, betting on a comeback, or sell one where they're too high, betting on a drop.
Kind of like being a market psychologist, figuring out what everyone else is thinking and then doing the opposite.
Uh-huh. That's a good one.
Yeah.
And one big lesson from this approach is good companies don't always mean good investments, and bad companies aren't always bad investments.
Wait, really? But we're always told to buy the best companies, the leaders.
It's all about the price. If everyone already knows a company is great, its stock price might already be sky high. You pay a premium, but you might not get much return.
Like buying a fancy car, but you paid full price and it's already lost half its value the second you drive it off the lot.
Exactly. And on the
Yeah.
flip side, if everyone thinks the company is terrible, its stock might be super cheap. Even if it just gets a little bit better, you can make a killing.
So it's not about the company itself, it's about how the market perceives it.
Bingo. And there's research on this too. There was this study, they look at companies that met all the criteria for excellence from that famous book, In Search of Excellence.
Oh, yeah, I've heard of that one.
Well, those excellent companies, they were in great shape financially, but the so-called unexcellent companies, those actually had better returns for investors.
So sometimes it pays to be a contrarian, go against the conventional wisdom.
And another study, they looked at stocks based on their quality ratings, like credit ratings, but for stocks. Guess what? The lowest rated stocks, the ones everyone thought were junk, they did the best.
Wow, that's wild. So just because a company's high quality doesn't mean you'll make money investing in it.
It all comes down to the price you pay. Now, contrarian investing isn't just about stocks. You could also invest in things like distressed debt.
Distressed debt, that sounds intense.
It is.
Yeah.
That's debt from companies that are having financial problems, maybe even close to bankruptcy.
So you're like a financial firefighter going into the burning building to rescue what you can.
Haha, that's a good one. Distressed debt investors, they're betting that the company will either recover or get restructured, and that debt will become valuable again.
Sounds risky.
It is high risk, high reward. You really got to know what you're doing. But no matter what you're investing in, contrarian investing takes a certain kind of personality.
Like you got to be brave.
Brave, patient, that's for sure. You got to be able to hold on when everyone else is panicking. And you can't be afraid of uncertainty. Contrarian investing, it's inherently risky. You might be wrong.
It's not about guarantees, it's about calculated risks.
And you need discipline. The market's emotional. It'll try to get you to react, make rash decisions. Contrarians, they got to stick to their plan.
Stay cool under pressure. Okay, let's talk about the last one, the activist investors. These are the folks who aren't just buying stocks, they're trying to shake things up, right?
Oh, yeah. They get involved. They take a big stake in a company and then push for changes, things they think will unlock value for everyone.
So they're not just passengers, they're trying to, like, grab the steering wheel.
Exactly. They might want to replace the CEO, restructure the whole business, sell off parts of it, anything to improve things.
Sounds like they're not afraid of a little fight. And there are different types of activist investors, right?
Oh, yeah. You got the lone wolves. Those are the individuals like Carl Icahn. He's famous for going after big companies, and he doesn't mess around.
He's like the Wolf of Wall Street.
Uh-huh. Something like that.
Yeah.
And then you have the institutional investors like pension funds, mutual funds, those guys. They might not be as loud, but they own a lot of stock, so they have power.
So even the big guys can get in on the action.
Absolutely. And then there are the hedge funds, private equity, those folks. They often want to take companies private, make big changes, and then maybe bring them back to the market later.
Sounds like a lot of moving parts. So do these activist investors, do they actually make a difference?
Well, it depends. Sometimes they do, sometimes they don't. One way to tell is how the market reacts when they get involved. Often, stock prices jump up when an activist investor shows up.
So like a vote of confidence, people think they're going to make things better.
Could be. But those initial bumps, they don't always last. Activists, they often have a short-term focus. Get in, make their changes, and get out.
So gotta look beyond the headlines, see what the long-term impact is.
Absolutely. Now, what do they actually do, these activists? Well, one thing is they try to change how the company uses its assets. Might sell off parts that aren't doing well, buy new stuff, streamline the whole operation.
Like they're cleaning house, getting rid of the clutter.
Exactly. And they might try to improve how the company runs, cut costs, find new ways to grow. Or they might mess with the company's financials, like using more debt to boost returns.
So they're looking at the company from all angles, trying to optimize it.
And they often push for changes in how the company's governed, make the board more independent, tie executive pay to performance, stuff like that.
So more accountability, transparency.
Exactly. They often say that management gets too comfortable, too focused on themselves, not on the shareholders.
So the activists are there to, like, keep them honest.
You got it. Now, all these strategies, they don't always work, of course. But overall, the research suggests that activists can be a good thing, at least in the short term.
So they can be a force for positive change.
Often, yeah. Studies show that companies targeted by activists, they tend to get more profitable, their stock prices go up, and their governance improves.
But like you said before, the long-term impact, that's harder to measure. And for the investors who bet on these activists, it can be a bumpy ride. So it's not just like an automatic win.
Definitely not. Activist investing, it's complicated, and it can get pretty messy. Not something most regular folks would want to get into.
Yeah, I don't think I have the stomach for those boardroom battles.
But we can still learn from these activists, right?
Oh, absolutely. What are some of the key takeaways?
Well, I think one big one is don't just blindly trust management. Ask tough questions.
Don't just believe the hype.
Exactly. Activist investors, they're always looking for signs that management might be screwing up, and they're not afraid to call them out.
And even if we can't be activists ourselves, we can still benefit from what they do, right?
Absolutely. If you can spot companies that are likely targets for activists, you might be able to ride that wave, buy the stock before it jumps up.
So it's like playing chess, anticipating the next move.
And I think activist investing also shows how important corporate governance is.
You've mentioned that before. Can you refresh my memory?
Corporate governance. That's basically the rules of the game, how the company's run, who makes decisions, all that stuff. It's about making sure the company's acting responsibly, ethically, and looking out for the shareholders.
So making sure the company's not just a free-for-all, everyone doing their own thing.
Exactly. Value investors, they believe good governance means better performance in the long run. Companies that are well-run, they tend to be more profitable.
Makes sense. But how do you even, like, measure corporate governance? What should I be looking for?
There are these companies, proxy advisory firms, they actually rate companies on their governance, give them scores, make recommendations.
So you can kind of outsource that part, get the experts to weigh in?
Yeah, to an extent. But it's always good to do your own research, too. Read those proxy statements. They have lots of details about how the companies run.
Still got to do your homework.
Now, here's a big one that applies to all types of value investing. Diversification.
Ah, the classic don't put all your eggs in one basket advice.
You got it. Especially for value investors who are often buying risky stuff, diversification is super important.
Spread the risk, right? So if one thing goes bad, it doesn't wipe you out.
Exactly. But the tricky part is, how much do you diversify? It depends, how much risk you're comfortable with, how long you're investing for, how confident you are in your picks.
So no one-size-fits-all answer.
Nope. But there are some guidelines. Like you want to diversify across different types of assets, stocks, bonds, real estate, that sort of thing.
Like a balanced diet, right? A little bit of everything.
Haha, I like that. And you want to diversify within each type of asset too. So if you're buying stocks, don't just buy all tech stocks or all energy stocks. Spread it around.
Don't bet on just one horse. Spread your bets across the whole race.
And how much you spread it around, that depends on how good you think you are at picking winners. If you're super confident, you might be okay with owning just a few things.
So the better you are, the less you need to diversify.
Kinda, yeah.
Yeah.
But even the best investors, they get things wrong sometimes. Nobody's perfect.
So diversification, it's always a good idea, even if you think you're a stock-picking genius.
Okay, now here's the big question. Does value investing actually work? Your research had some mixed results, especially when it comes to those active value investing funds.
Yeah. I mean, Buffett's done great, but those funds, they haven't always lived up to the hype. Some studies even say they underperform, especially with the big, well-known stocks.
It's true. It's a bit of a head-scratcher, isn't it? You'd think those professional investors, with all their resources, they'd be crushing it. But it's not that simple.
So what's going on? Are they just not as good as they say they are?
Well, one problem might be that they're too focused on the short term. They got to show results every quarter. So they might end up doing things that aren't really true value investing, which takes time to work.
Ah, right. The pressure to perform can make you stray from the true path.
Exactly. And another thing is the market's gotten more efficient. More people are using these value investing ideas. Information's easier to get, so it's harder to find those hidden gems.
It's like everyone's looking for the same gold nuggets, and the stream's already been panned out.
Good one. So if the pros are struggling, does that mean Regular folks have no chance.
Yeah, that's what I was wondering. Thankfully, the research had some good news for us regular folks. Some studies found that individuals who don't trade as much, who stick with their picks, they tend to do better.
Interesting, right. It might be that those folks, they're more disciplined, more patient, just like those classic value investors.
So it's not just about the techniques, it's about having the right mindset.
And the research also found that these successful individuals, they often invest in companies close to home. Maybe they have some extra knowledge about those local businesses.
Invest in what you know. That makes sense.
And they tend to own fewer stocks, too, which means they really believe in their picks.
So it's not about spreading yourself too thin, it's about focusing on the best ideas.
Exactly. Now, these studies didn't say these folks were definitely value investors, but they sure acted like it, right?
Like they were following the principles without even knowing it.
Uh-huh, maybe. But here's the thing. Even if regular folks have a bit of an edge, beating the market consistently, that's still really hard.
So, gotta be realistic. It's not like a guaranteed path to riches.
Definitely not. Value investing, it takes work, it takes patience, it takes understanding how businesses work. It's a marathon, not a sprint.
And you gotta be willing to learn and adapt, right? The market's always changing.
Absolutely. So let's wrap this up. What are the big takeaways here?
Yeah, lay it on us. What do we need to remember?
Well, first, value investing, it's not just a bunch of formulas and tricks. It's a way of thinking, a philosophy. It's about finding things that are worth more than what they're selling for and taking advantage of that.
It's like being a detective, a bargain hunter, and a long-term thinker all at once.
And second, it takes the right kind of personality. You got to be patient, disciplined, and okay with not knowing what's going to happen next.
It's not for the faint of heart.
And finally, it's not a guarantee. Even the best value investors have bad years. The market's tricky. It's always changing. Finding those undervalued gems, it's a
No.
challenge.
So stay humble, stay adaptable, and keep learning.
Exactly. It's a journey. Okay, now, here's the big question we got to address. Does value investing still have a place in today's world?
Yeah, that's the elephant in the room, isn't it? Is it still relevant? Or have things changed too much? It really is. I mean, we've looked at how value investing got started, all those different tools and ideas, and even the personalities behind it. But does it, does it still hold up? Is it still a good way to invest?
Yeah, that's the big question, right? And honestly, it's tough to say for sure. The market, it's a different beast now than it used to be. Some things have changed that make value investing, well, maybe a little harder.
Like what kinds of things?
Well, think about all these index funds, those passive investments.
Right, where you just kind of buy the whole market, not individual stocks.
Exactly.
Yeah.
That's pouring tons of money into the market. But it's not based on any real analysis of individual companies. It can mess up those classic valuation metrics.
So it's harder to find those bargains, those hidden gems.
Could be, yeah. It's like the noise is louder now, harder to hear the signal.
And you mentioned before, like the whole world's just more unpredictable, right?
Right. All those big economic events, interest rates, inflation, all that stuff, it can really move the market, regardless of what individual companies are doing. Makes it harder to focus on just the company itself.
So even a good company, a solid business, it could get dragged down just because the overall mood is bad.
Exactly.
Oh.
And it's not just like natural economic cycles anymore. Governments are stepping in, printing money, doing all sorts of things that can make those old valuation models, well, they don't work as well as they used to.
So it's like the rules of the game are changing. The playbook's got to be updated.
Maybe, yeah. But does that mean value investing is dead? Nah, I don't think so. It's not about blindly following rules. It's about adapting. Those core principles, they can still work, but maybe we need to, tweak them a bit.
Tweet them how?
Well, one thing is, gotta pay more attention to that big picture, those macroeconomic forces. Can't just ignore them anymore. Gotta factor them into your analysis.
So understand the currents before you try to sail.
Exactly. And maybe got to be even more picky about which companies you choose. Not just looking for statistically cheap, but really understanding the business, the management, making sure they can handle whatever the world throws at them.
So quality matters even more now.
For sure.
Yeah.
And got to stay disciplined, patient. It's easy to get caught up in the hype, chasing quick profits, but that's not what value investing's about.
It's about that long game, right? Planting seeds and letting them grow.
That's it. Value investing, it's been around for a long time. It's been through ups and downs, but it always seems to come back. People forget about it. Then they remember, oh yeah, this actually works.
So maybe it's not about abandoning it. It's about rediscovering it, adapting it to the new world.
That's a good way to put it. But here's the thing. Even if we adjust, even if we get everything right, There's no guarantee, right? The market, it's still unpredictable.
So gotta be realistic, gotta manage expectations.
For sure. Okay, so all this stuff about value investing, it can be a bit overwhelming, right? Where do you even start?
Yeah, honestly, I'm feeling a little lost. Like, how do I take all this and actually use it?
Well, first, don't panic. You don't have to become an expert overnight.
Hmm?
Start by asking yourself some basic questions.
Like what?
Well, how much risk are you comfortable with? Are you okay with those big ups and downs, or do you need something more stable? That's a big one.
Yeah, makes sense. Can't just jump into the deep end without knowing how to swim.
And then think about your time horizon. How long are you investing for
Yeah.
retirement? Short-term goals. That makes a big difference.
Right, like, am I sprinting or am I running a marathon?
And think about what you're interested in, what you know about. Maybe you have some insights into a particular industry. That can give you an edge.
Invest in what you know, right?
Exactly. And no matter what, always do your homework. Don't just trust what you read online or hear on TV. Dig into those financial statements, understand the business, the competition, the whole picture.
Be a detective.
And remember, you don't have to do it all alone. There's tons of resources out there, books, articles, podcasts even. And don't be afraid to talk to a financial advisor. Get some professional guidance.
So, like, build your team, get some support.
Exactly. Investing, it's a journey, and you don't have to go it alone.
Well, this deep dive, it's definitely been a journey for me. We've learned so much, from the history of value investing to all those strategies and tools, and even how to think about the market differently. It's not just about picking stocks, it's about like a whole philosophy, a way of life almost.
And remember, the most important thing you can invest in is your knowledge. Keep learning, keep asking questions, and you'll be well on your way.
That's great advice. Thanks for joining us on this deep dive into value investing. We hope you've learned something valuable, something that'll help you on your own investing journey.
And hey, the journey never ends, right?
Mm.
Keep exploring, keep learning. Those hidden gems are out there waiting to be discovered.
That's a great way to put it. We'll see you next time on the deep dive.